The Magellan Fund was the best performing fund from 1977 all the way up to 1990. As you can see in the graph below, it shows how much $1 invested in either the Magellan Fund or the S&P 500 would have returned after the 13-year period. If you had invested $1 in the Magellan Fund in early 1977, by the end of 1990 you would have had $28.14. Whereas if you had invested $1 in the S&P 500 at the start of 1977, by the same time period you would have had $6.60, which shows clear outperformance. By focusing on growth stocks, the Magellan Fund was able to perform over 4 times better than the S&P 500 over the same time period. But who is the man behind this incredible outperformance? Well, it's none other than the famous Peter Lynch, otherwise known as the father of 10 baggers. If you had read one of his books, you will know what I'm referring to. He always mentioned in all of his books that all investors have an edge, and he is a clear believer that retail investors, us individuals, have a big advantage over funds because of 2 major things. The first one being that we have more freedom to choose our investments. We don't have to report, do annual figures, or tell anyone what we're buying. And the second one is that we're able to buy smaller cap stocks, which usually have higher growth rates. So while being the head of the Magellan Fund, he was able to return 29.2% per year from 1977 all the way up to 1990, marking this as the best performing fund in all mankind history. So he was a firm believer of 3 principles. The first 2 are combined, being invest in what you know and local knowledge. He said that everyone has an area of expertise. For example, I'm a big fan of sports, so I should focus in sports companies, look at companies I like, for example, Nike, or smaller ones that are just starting, for example, Topgolf. Well, it's not just starting, but it's a smaller one, and invest in them if I like the product, if I like their financial analysis, if I see them expanding and obtaining high growth rates. And the third principle is that 10 baggers are everywhere. 10 bagger is a principle, it's a kind of word he used a lot. It defines a stock which is able to multiply its value by 10, so return a 1000% return over X amount of period. So he said that it's obvious that studying history and philosophy was much better preparation for the stock market than say studying statistics. So he believes that statistics do not make a lot of sense and that the stock market is a lot more based on common sense. So he used 5 main important metrics. This is just a representation of kind of his investments. He didn't follow a specific framework. He's known for being one of the investors who had the most amount of stocks under his portfolio. So it would be crazy to replicate his portfolio, but some of the main metrics he used in selecting stocks we have replicated here. The first one being that he never ever invested in utility companies, and if he did, they weren't great investments. And this is because of 2 things. They are usually very slow growing companies, and they are found in highly regulated industries. So for example, water companies, or for example, energy companies. They tend to be slow growth. I'm not talking about renewable energy, I'm talking about energy companies, the ones that carry the energy to houses, for example. They're slow growth and they are highly regulated, so they're not good to invest in. Second one is that he used to focus on smaller caps. These are companies that were not bigger than 1 billion, but of course, years ago, finding companies that were smaller than 1 billion was a lot easier than nowadays. And this is because there are more growth opportunities ahead. So for example, if you're a company that has revenues of 200 million, increasing them up by 10 times from 200 million to 2 billion is a lot simpler than, for example, if you're Apple and you have revenues of 1 trillion and you want to times them by 10, because you have a bigger addressable market than the one you already have. The second one is the third one, is the 12-month trailing PE ratio. So you want this to be in the top 25% on the industry, which makes it a lot more attractive. The fourth one is the EPS growth, which is that the 5-year average EPS growth should be greater than 15%. And the final one is that the institutional ownership should be around in the bottom half of the industry. This is because you want to focus on those companies that actually nobody has heard of. Institutions haven't picked up on them, because when they do, they will push the stock price up and you will be inside the stock enjoying the ride up. So by using these 5 main principles and then some other parameters I'm going to be showing you in the following slide, they created the Lynch strategy, which is a strategy kind of trying to replicate what investing Peter Lynch used to do from 1977 to 1990 with the Magellan Fund. As you can see, it has beaten the S&P 500 by a lot. It has not managed to get to the same levels as Peter Lynch got to, but it has been pretty good at beating the S&P 500. As you can see, the annualized return for the Peter Lynch strategy from 2000 to 2022 was around 18.3%, whereas the S&P 500's annualized return was around 6.4%. In terms of how to valuing a stock, Peter Lynch has not disclosed a lot of information. I believe he wasn't a maniac at trying to find which stock was at an attractive price. Whenever he found a good stock, a very good company, which had high growth rates and high return on equity, he would just jump in without worrying too much about valuations, because he's one of those investors which focused on 20-year investing, not 2 or 3 months or 1 year investing. One thing he did look at was the historic PE ratio, which is just getting a graph of how the PE ratio for the company has evolved, where it's sitting at and where it has been sitting at for the previous 2 or 3 years, for example. That way you can see whether it is undervalued or overvalued in regards to its historic trading prices. He believes that the pricing as well is not too important, so he focuses more on 2 factors. The first one being the 5-year EPS growth, to see the growth rates of the company and if they're sustainable, and then the 5-year return on equity, which is important because it shows how well the company is at creating value for investors. So these are the 8 things. He used to look at a lot more things, but this is what was used for the creating the Lynch strategy. So the first one is one that he said in the books, which is that the business should be simple enough so that you can explain the business to a 10-year-old without using complex ideologies, meaning that you should understand the company. So it's better to understand, for example, one of his biggest investments and best returning investments was Dunkin' Donuts, which is what? Selling donuts and selling coffees. So that is a lot simpler to understand than, for example, getting into all microchips, understanding which machines one company is creating and all that. If you understand it, that's great. If you don't, maybe you should stick to other businesses, because you will never know what's going on in that world and you will not know when the fundamentals for that company are deteriorating or not. But apart from that, he said that he's looking at institutional ownership. The lower, the better. He's always looking at the number of analysts covering the stock. The lower, the better. So you can see here, the 26-week price percentage change should also be lower, the better. You can see here that he likes looking at undervalued stocks a little bit, but he likes looking at secretive stocks that are not being covered by the media a lot, stocks that don't have a lot of coverage by analysts, that are not being backed by institutions. And once he has a list of those companies, just looking at the fundamentals, the growth rates, and the return on equity. He also talked about having a healthy liability to asset ratio and a solid 5-year EPS growth compared to its industry, as well as a 5-year average return on equity, which should be acceptable and higher than the industry. Finally, he looks at the 20-day exponential moving average, which should be over the 200 exponential moving average. This is more of a technical term, and I don't believe Peter Lynch used this, but it was used to create the Lynch strategy, and so far, since we've seen, it's working pretty well, so it should do no harm to actually apply that to the filters of your screeners. And then Peter Lynch basically said that the key to a great investment is the combination of, first of all, a high 5-year EPS growth, which usually represents a strong competitive advantage and a desirable product. Second thing is a 5-year return on equity, which of course is essential when a company is trying to create value for the investor, which is what us investors should be looking for. And the third one, of course, an attractive historic PE ratio, so you can buy the company at an attractive price. However, this one I don't believe he was too keen on. This altogether combines to create a great investment. with high returns. But before we move on, I have to recommend you and advise you, of course, I'm not a financial advisor. All the videos I do in this channel are for myself to learn from, to push myself to do stock analyses, to learn about investors, and just to inform myself. So don't take this as financial advice. I actually do not follow his strategy. I follow more of a Terry Smith style, but I'm just putting this out here to learn more about Peter Lynch, since I really, really like him as an investor, and for you guys also to learn about the different investment techniques that great investors have had throughout their times. Anyways, said that, thank you for watching. This has been the cash flow compounder. As always, you can join the free Patreon in the link below for extra content, and if you click the link in the bio, you can get a free stock by registering into Trade Republic.